yesterday we had a panel with very famous European VCs, and now we want to hear the same type of stories of visionaries for the actually next 10 years from the other side of the Atlantic, from the US. So without much further ado, I want to welcome Jeff Clavier, David Hornik, Benjamin Ling, Shervin Pishevar, and to moderate the panel, Roxanne Varza. Oh, of course.
Thanks, Paul.
Thank you.
Bonjour, Roxanne.
Bonjour, merci.
Hello, Jeff. Hey, man.
Well,
Hey, rockstar.
Great, I'll let you guys take a seat. So thanks so much for being here. We have a great seat in the middle for an investor. No, I'm kidding. We're looking forward, but before we get started, actually, I want to take a look back. Some of you have been investors for over 10 years. I think, David, you started in 2000. Jeff, you launched your fund in, what, 2004? It's been
2004, but I was an investor for 4 years from 2000 as well.
Okay, so we've got over 10 years of experience there. Shervin, I think you were investing even prior to Menlo. And Ben, I know you joined Khosla recently, but you told me you'd been investing quite a while before. What did you guys think back when you first started, or about 10 years ago, that we'd be seeing companies like Instagram, Snapchat, Tumblr being worth billions? Did this even cross your mind back then?
Well, Jeff and I came into this business when it looked like everything worked, right? This was in the late 90s when literally everything was working. You'd create a company, you'd add .com to it, and you could take it public. And so if anyone had thought about it at the time, we would have said, gee, that's not sustainable. But it was so intoxicating, this idea that we just take anything to the web and it works, and it's this amazing transformation. And so, yeah, I think we all thought that everything we touched would turn into billions of dollars. The interesting thing is that then very shortly thereafter, the economy bottomed out, it got very hard, it looked like we wouldn't be seeing that sort of excitement again for a long time. But the thesis back then was absolutely right. And now all of those things that we thought you would take online, you know, cars and selling things and interacting and dating and marriage and all those things are now massive. So it turned out to be right. It just took us an extra, what, 12 years or whatever.
So I will just fix one thing, which is that I agreed to become a VC when it was all rosy in 2000, but I moved to the Valley in August of 2000 once everything had gone to shit. And what was interesting is that I met a bunch of companies which made absolutely no sense, had raised a bunch of money and had no product, no market, no product market fit. And when about 4 years later, I saw the first generation of consumer internet companies that were very capital efficient with a prototype, the idea of how to market the product. It made sense to me, which is why I started SoftTech.
So to your question of these billion-dollar companies, if you rewind the clock back to 2006, 2007, there were a couple of them that we thought were maybe crazy at the time. One of them was YouTube, and the other was Facebook, right? So 2006, Google bought YouTube for $1.6 billion. People thought, wow, that's really, really crazy. But today, when we look at YouTube, it's a huge, huge phenomenon, and I was lucky to work there. Facebook, $15 billion in 2007, and people thought, whoa, that's crazy. But today, Facebook is over $100 billion market cap. So we've definitely seen this before.
Shervin, you agree with all that?
Yeah, I mean, I think for me, it's I've been an entrepreneur all my life. So when I started angel investing, that was 2007. I first made my first check. I had like 500. I think I started with like everything I had was about $500,000, and I just put it all in, all the chips on the table. And it wasn't because I believed I was going to find $1 billion company. It was because I really liked the founders, and I really liked the ideas they were working on. And so I think when you go back to the kind of pure roots of Silicon Valley, guys like Steve Jobs or Hewitt and Packard in a garage, I don't think they set out thinking we're going to build a $500 billion company. I think all of them would be like, that really happened. I think they all were trying to solve a fundamental problem they were passionate about. So I think starting at the seed in the same way that many of us have done, it's about kind of finding people with crazy dreams, trying to solve big problems. And the purity of that is what I think attracts all of us to what we do, not the $1 billion number.
Great.
And if you go back to the very successful companies, they were never obvious at the time someone made a call. I remember, I'm not sure whether you remember, but right after Breyer put 17 million into Facebook at close to 100 posts, you and I had lunch, and you said, Breyer's lost it. It's completely crazy. We've seen the guy, he's great. 40, 50 pre would have made sense, 80 pre is insane. And you know what? That was probably the right, sort of comment, except that he turned that into, 12 billion for Axel? Like 100 million into 12 billion? So, you never know, because you expect something to work, but not work so crazily that you end up not with $1 billion outcome, but with $100 billion outcome. And that's what makes our job pretty exciting, to be honest.
And that's a huge change, frankly. I mean, it is not the case that 10 years ago, people were looking at $100 billion outcomes. That's not, you wouldn't look at a Twitter at trading up to 30 billion. You didn't look at a Facebook. You didn't see LinkedIn trading to tens of billions of dollars, right? That is actually a huge change, and it changes how people think about the economics, right? Because suddenly what difference does it make whether you pay 100 million or you pay 200 million if it's worth $40 billion? Well, that is true. It just turns out that it's almost never worth $40 billion. So that the job of investing is actually really tricky, because you have to distance yourself from these things that you've seen, that you've maybe missed. You've had near misses with these things that turn into gigantic companies, and say, that is an outlier. Let's talk about the universe we live in, because that's what matters. But it's very tricky, and it's gotten trickier when you have the Snapchats of this world allegedly turning down $3 billion acquisition offers. You have companies that turn into tens of billions of dollars in market cap in 3 or 5 years. That's crazy.
So let's actually talk about Snapchat, because I'm discovered backstage nobody here is actually an investor in that company. Missed opportunity? I'll start with Jeff.
In terms of investing? Or
in terms of an investor?
We had actually had that conversation with my team, and I'm 10 years older than my partner Charles, and I said, this is completely stupid. And he said, dude, I would have absolutely rejected the $3 billion offer. Given the traction they have with that demographic, it was worth it. And so, what can I say? We didn't see Snapchat. I don't think we would have done it, because this is so far away from what we actually invest in and are excited about. If they can actually turn this thing into $10 billion in real value with great monetization, all the power to them. But $3 billion for this kind of thing is pretty crazy talk. We've trivialized the billion.
Thank you, exactly. Let's bring the billion back as something that matters.
Yeah.
Look, I'm roughly the same age as Charles, and I agree with him. The traction that Snapchat has with that segment, and also above and below, is stunning. So my friends and I use Snapchat all the time. It is very much a picture messaging, like funny messages. People use it different ways, but there's so much traction that it has, and that addiction toward using that product. Maybe it will shift, but right now they have that moment. And so Instagram, when you look at Instagram's sale to Facebook, you wonder, was that a good sale or was it a bad sale? It depends on how you look at it, right?
It was a fantastic buy for Facebook.
Yes, it was an excellent buy for Facebook. Right. So it's still the jury's out if Instagram were a standalone company, how it would be faring, so on and so forth. But it is a little crazy when you say $3 billion. But like you said, there's these platforms that are 20, 30, and sometimes it's very hard to predict what happens.
But here's the thing that is tricky, and the thing that I have a very hard time appreciating. We've recently seen. I'm too old. No, my kids. I have kids, thankfully, so I get to live through them. They use Snapchat in very interesting ways. The question for me is a question of monetization. It's not a question of usage. So we recently saw these numbers that may or may not be true, leaked from Uber, but that's a big business, right, Shervin? There are real dollars moving through Uber, so it is not hard to go, oh, this thing is valuable because it's moving a ton of value, right?
I think that's exactly right. But if you look at it, Google. The early argument against Google were that's another search engine and there's no way to make money, right? But yet Google is one of the largest technology companies today. YouTube, the same similar argument was applied, which is it's
I don't
cats on
think
videos.
so. I don't think anyone had any question that you could make money on YouTube. Whether people thought they could make money on
In retrospect, yes, but
No,
at the
not in
time,
retrospect, not in
at the time,
retrospect at
people
all.
were arguing that there's so much premium content and you can't monetize the premium content because the partners don't like it, so on and so forth. And then everything that's left is UGC, and no advertiser will ever advertise on UGC. And that's the argument that we face at YouTube constantly with the advertisers.
So I think there's going to be no argument that monetization is always going to be an issue, going forward, going backward, what have you. I do want us to come and look at some of the future trends, obviously, because that's what the panel's about. And I think Fred actually did a great job of addressing some of what he sees as being future trends. But I want to jump into one space that I think is really interesting and that some of you have actually got investments in, and that happens to be in the medtech space. And I'll start with you, Ben, because I think Vinod made a comment recently that got a little bit heated in the press, but I thought it was a terrific comment. It's 80% of medical or doctor tasks are going to be replaced in the next, I think he didn't even give it, or gave it more than 10 years, but in the next something like by 2025.
Right, and that's a toned down version of the statement.
Is it?
It used to be that machines would replace doctors.
I didn't want to quote that because I know that's exactly where the argument started from, and he said it was wrong.
But if you think about it a little bit, so if you think about what doctors do, a lot of it's actually pattern matching, right? So doctors go through an extensive education, and they learn all sorts of very important facts and patterns, and then they go through a long time of training with actual people, and then when they see new patients, they say, okay, well, Jeff, it looks like you have the following symptoms, you look a little bit sluggish maybe, so therefore I'm diagnosing you with X, right? And they're basically looking at their database, their personal database of facts, and their own pattern matching. But if you could imagine, if you could take all of that data and all those patterns and actually map them into a database and make that available accurately to people, then you basically have this sort of perfect doctor. And so that's where the sentiment comes from. The idea that a lot of it is actually available via data and patterns. If you could actually accurately map that and then accurately get the symptoms and diagnoses, so on and so forth, you could actually automate a lot of that behavior and make doctors much more effective.
So is that the direction that we're actually headed in? Replacing doctors?
I don't know if replacing doctors is the right term, but we can make them significantly more effective. And I think that's true of a variety of different professions, not just doctors.
But it looks like right now we're kind of a bit away from that. In the healthcare space, we have a lot of wearable technologies that you guys have invested in. Do you want to provide some examples of what you think will be the next really strong wearable kind of health technologies?
So I think glasses will be sort of the form factor that lends itself naturally into an operating room or in an onboarding desk and so on and so forth. So we looked at a couple of very, very early stage opportunities leveraging the Google Glass. And the problem is that the Google Glass, the first generation, is just not there yet in terms of battery life, in terms of features and so on and so forth. So we sort of held back. But I think that one of the key trends is that a lot of those traditionally super hard to penetrate verticals, whether it's med tech, ed tech, gov tech, are now sort of breaking up and opening up to massive billion-dollar opportunities, $1 billion. And so we're very excited to actually do, and we've done our first medtech investment. It's Better Doctor, which is actually a very easy Yelp for doctor. 70 million US people change doctors every year, and it's a total mess to do that. And so we'll help facilitate that.
Have you guys also got additional health or med tech investments?
At Sherpa, we helped basically the birthing process of a company called House Call, which is really around the space of capacity utilization and making doctors' lives more efficient and patients' access more efficient. So it's basically you can push a button and have a doctor or nurse come to you. And one of the founding Uber guys, Oscar Salazar, is the founder of that company. He wrote the original Uber app. So it's launching in New York, and it's then launching in San Francisco. So we're pretty excited about House Call.
So what is this? It's an app that essentially you can get a doctor to come to your house?
Do a house call. Very traditional.
I can give you an example in the KB portfolio. The company's called CellScope. And the product description is basically an attachment to the iPhone that allows parents and doctors to be able to take a photo of the inside of the inner ear. So you may or may not know that one of the most common causes for bringing children to the hospital is ear infection or ear pain. And so what this company does is it enables doctors to be able to take photos and videos of the ear, store it in a database, and match previously imaged photos and get a diagnosis from that database. So that's another example of using a large database of data to be able to pattern match and then give an accurate diagnosis. And the good thing here is that you can also take the tip, hand it to the parent, and then you can take it home with you. Instead of having to bring the child back into the doctor's office, you can have a phone call with the doctor instead. So that's an example of this large pattern of data, and then utilizing that database to do better diagnoses.
So even outside of kind of the health space, I think there's some of these devices that are getting really interesting. I think one investment that you did recently was Coin. I don't know if anybody else was involved in that one as well.
Yeah, Coin.
I loved that. I think that's an incredible product. What are we seeing kind of in the device space aside from med that could get really hot? What is kind of like the upcoming trend?
So our thesis in investing in devices is we want mass market appeal devices where it's very simple, crisp value proposition, and we've done 3, which is the Fitbit. I was the seed investor 5 years ago. We've done Coin, which has basically done the most successful pre-launch campaign in history to date, and obviously someone will eventually do better. And then we've done August, which is the connected lock, and those are very simple products that will have millions and millions of users, and it's all centered around one thing: the smartphone. You have so much opportunities in terms of Bluetooth Low Energy, the computing power, the connectivity of your smartphone, that everything connects to it, and then it becomes the gateway. And you don't have to spend more than a few dollars to embed a Bluetooth Low Energy chip in your product to take advantage of all that. So really, the smartphone becomes the key disruptor for that market.
And I think what was especially interesting about Coin, I mean, you mentioned that they had a pre-launch that was incredibly successful. I don't know how many hits their YouTube video got and the crowdfunding campaign. And I thought the crowdfunding and the VC complement is starting to get really interesting. How do you guys see crowdfunding playing out, given that you're all kind of working for more traditional funds?
So let's be clear. What we did was a pre-order campaign, and yes, we've made a boatload of cash, but it didn't really sort of fund the company, just put a bunch of money in the bank because people bought the product in advance of it being available. And so when people say, oh, it's an alternate source of funding for us, the way we look at it is it's just validating demand. We were hoping to get a few thousand people to buy the coin, and yeah, we got more than that, but it just validated that it was a mass market product with mass market appeal. And when we look at all those pre-order campaigns, it's not so much the cash that is interesting to us, it's just the validation that people actually want to buy it.
Yeah, I think sorry, go ahead.
No, I was just going to say that I think that this is particularly true of devices. I mean, one of the challenging things about devices is that when they work, it's extraordinarily expensive to produce the devices that you need to get market penetration. And I think Jeff is right. Like all these things, ultimately we're talking about data. The value of these companies, even when their devices, is in the data and in the software that's managing it. And in the end, that the economics of those businesses are going to be derived in large part by the software and the ongoing services around them. So how do you fund that, the big expense of producing these things? Well, there's no question that Kickstarter and other, as Jeff calls them, pre-order campaigns, this ability to say, people want this thing, let's have them pay for its manufacture, is incredibly powerful because it does 2 things. One, it validates the demand for the thing. I pre-ordered a coin, but it also then pays for it up front. I mean, one of the challenges with these Kickstarter-like campaigns is that oftentimes the campaign will raise a lot of money to produce the thing, but the cost of actually creating it and the team to produce it, all of that, hasn't been calculated into the price. And suddenly, you don't have the money to both design it and manufacture it. That's a huge problem. So in these instances where there are venture-funded companies that are looking to the public to pre-order and pay for the manufacture, you cover both sides of the equation.
So as an investor, though, it's still very interesting when these devices are all getting crowdfunded, but you're just telling me that they actually need additional capital. It's not actually a real investment, what they're raising.
It's not just capital, it's also the help. So I would think of the crowdfunding, so there's a question that you asked, which is crowdfunding disrupting the venture model? And I would say actually no, it's giving the venture model even more data and more signals. So historically, you'd have different phases. The first phase would be, can you make the product? There's product risk. Then there's the product market fit, right? So here in the crowdfunding models, we're seeing a lot more of being able to sell a product via video, pre-sell it. So you get a sense of the product market fit even before you know that the product can really be built, or that this team can build the product. So it's just giving us a little bit more data. It doesn't guarantee that it's going to be it's perfect product market fit, but it gives you, one additional signal. And the additional thing here is, so I agree with everything that's been said. There's the financing that comes from some of these pre-sales, but then the question is that sufficient to take the company to the next level? And there's oftentimes A, funding that's needed, and B, also help that's needed. So, the venture capital model, so we like to call ourselves venture assistants at Khosla Ventures to differentiate ourselves from the capital. So the assistance is the help that we give to the companies versus the capital. And so to the extent that you believe that VCs and venture assistants can help companies, then it's not just the money.
Ironically, I think the most disruptive crowdfunding trend is AngelList. So you look at it from what's going to disrupt venture itself. I think AngelList is something we should probably talk about here. Not sure how you guys feel about it. We invested in it because we believe it's actually a good thing for the market. But I'd love to hear your thoughts on AngelList.
Well, I think that it serves a real purpose, that there are people who are getting value from it. But do I think that it's going to disrupt my piece of the venture business? No, I don't. I don't think that. And I think that. And I think that the tricky thing is, it's arguably trying to disrupt the angel layer, the folk that compete with folks like you and Jeff. On the other hand, I think that there's a real and meaningful difference between getting funded by the two of you and getting funded by a group of people, whatever that group may be, right? And so ultimately, I think that there will be a class of investments that will get done by the very best possible investors, and that the four of us sitting here will likely get to see those investments. We will be able to fund those companies, and we will help those companies in ways that are meaningful and meaningfully differentiated from being funded across an angels list. And so to a certain degree, if that remains the case, then there will be this challenge of the best companies rising beyond it, and the less obviously important companies being funded on angels list. And if that happens over a long period of time, then there'll be a very clear signal, and that will undermine the capacity for angels list to be transformative and disruptive. So I think that we're very early, but from what I see, the best companies continue to get funded by firms that have a reputation for being helpful in driving businesses to the next level.
I think it's not a zero-sum game in the sense that I see AngelList as an enabler for more types of founders and startups to be actually funded and financed, because there is just a certain finite number that we'll do 20 investments per year. And if you look at all the macro VCs, that gives capacity for 100, 200, 300 companies. However, not every company is an obvious venture financing candidate at the get-go. And I think that AngelList, from that standpoint, allowing angels to put together 100, 200, 300K, what used to be the friends and family financing, is usually disruptive. And we'll probably pass on all those super early financing, but we'll look at them as they progress. So I think we've always sort of been very supportive of AngelList. We passed on the round because it wasn't our kind of investment. But I don't see that as disruptive, as in it's going to eat my business, but it's going to help my business have access to more interesting opportunities.
Shervin, as you kind of kicked off the AngelList topic, I'd love to hear your thoughts on this.
I think Naval is one of the smartest people in the game. So I think the current model for AngelList is something that's going to evolve over time. I wouldn't be surprised if it goes from seed to A's and potentially more. So I think it is basically creating a very liquid marketplace. And whenever you have a very liquid marketplace, it is hard to contain liquids, right? They spread. So I think over time, we'll see where it goes. I agree with them that it's not a zero-sum game, that there'll be some complement of AngelList in some ratio within the greatest companies. And also, I think it's also a good trend in terms of just democratizing fundraising and allowing more people to be able to participate in more asset classes.
I think the true litmus test here is going to be when you have a great investor and they choose to invest solely on AngelList as a lead rather than A, starting their own fund, or B, joining a firm. I think that will be a very interesting sort of watershed moment because there will be more competition as a result. I don't know if it's disruption as much as it's competition, but the model that, for syndicates, for example, is very much similar to any sort of angel fund or VC fund in terms of the responsibilities associated with the lead.
This is actually a really important point because, limited partners, LPs, who make up the kind of the majority of the investment groups in venture firms, beyond individuals who are still classified as LPs. But institutional LPs are now able to kind of break out from investing in pods of investors within kind of the form factor of a venture fund and be able to actually invest in individual investors, whether it's syndicates, et cetera. And the reason for that, as we all know, is that in partnerships, the most of the returns come from a subset of the partners. So typically it's 1, 2, maybe 3 partners are carrying the load of all the other partners. And when you add the number of fees on top of that, it's not a very efficient system. So I think that kind of efficiency and the ability to kind of target individual investors who can bring the greatest returns, that could be disruptive because some of the greatest partners within a firm, like Hornik, for example, who has one of the best returns out there, could say, you know what, I'm just going to put myself out here and LPs can invest in me directly.
Yeah, but a couple of thoughts. One is, if you look at disruption, so back in 2007, I put together my first fund, which was a $15 million fund, and I had set the target of 15 because that's what I could raise in 8 weeks. And you don't raise a fund in 8 weeks in real life because it takes years of effort. It's really, really sort of challenging. You don't want to sort of spend all that time raising the fund. You want to spend it, investing. So if you could get a $10 million micro VC fund raised with the press of a button on AngelList, that is actually pretty interesting, especially for Fund 1. However, to the point of segregating the returns and just choosing the partner, yes, there is the person who leads the deal, but there's all the support that the entire team is producing, and therefore, a partner bet is really a partnership bet. We all work, there's 3 of us at SoftTech, we all work on every deal. And you can't say, oh, this is Charles' deal, or Steph's deal, or Jeff's deal. So the notion of saying, I can zero in on one specific sort of investment and partner is sort of...
I don't count your firm in that. What I'm talking about is the large partnerships, 7, 8 partners, billion-dollar funds.
Okay, so I think it's really interesting to look at some of these models. I think they potentially work better in the US than elsewhere for the moment, or at least that's what some of the numbers are showing. And so I want to kind of bring us over to Europe and get your thoughts also on what you've seen coming out of Europe. I know some of you have, I think you did a recent investment in a Croatian company, or that was probably about a year ago. If you have other European investments as well. And to get your thoughts on what do you see as the future for investing in Europe?
It's tricky because the ecosystem and the alignment of interest, which is for us building big, bold companies that will potentially fail, but if they're successful are worth billions, is not the European approach. And so what we've done most recently is that essentially we don't invest in Europe anymore. We move founders from Europe to the US because they have US sort of grade ideas.
What I would say is that every ecosystem grows around an anchor tenant, right? The reason Silicon Valley continues to be as successful as it is that there are a huge number of models that we can look to. Now you have Twitter and Facebook, but then we had Google, and before that Yahoo and eBay, and so and up in Seattle you have Microsoft and you have Amazon, and Chicago looked like it was going to get a big boost from Groupon, etc. So the good news is that what we now see in Europe is we see the Wongas and the SoundClouds and the companies that we think could be big and disruptive and truly building massive businesses, and that's great for the ecosystem because it does two things. It emboldens entrepreneurs to think big and build big, and then it convinces folks like us that there's an opportunity to invest in companies that will return scale results. And so I see that happening right now, and I think that will increase the investment in the angels, in the angel community in Europe, which will result in more companies, better companies, bigger companies, and we'll just get more and more engaged.
All right, guys, I think we're out of time. I'll take one last comment regarding Europe, and then I think we got to wrap it up.
Yeah, I was just going to say, there's obviously great talent and ideas everywhere in the world. With Khosla, we take a similar philosophy as Jeff, which is that we like to actually bring the founders and move them over to Silicon Valley. And it's not because Silicon Valley, well, it is because Silicon Valley is a magic place, in the sense that there's a lot of talent and a lot of the ecosystem of new engineers coming out of schools, great executives from other companies, make it much, much easier to build a huge company there than anywhere else. And it's not because the ideas are, or the people are necessarily better, there just happen to be a lot more of them.
Okay. Thank you very much, guys.
Thanks.
Thank you.
Thank you.